Welcome to this video on why trade options volatility. As the name suggests, in this video, you will learn about a few reasons why options volatility trading can be beneficial. John has been struggling to decide on his next trade. According to him, since the Fed meeting is coming up, there will be a big movement in the market. But he just doesn't know whether the movement will be in an upward or downward direction. So he goes to his friend Sophie for suggestions.
Instead of betting on the direction, why don't you bet on the degree of fluctuation?
That's exciting. Can you tell me more about this approach?
You can trade on the degree of fluctuation rather than the direction, and that's nothing but volatility trading. Let us continue with the view that you expect a big move, which means higher fluctuations. That means the volatility will be high. In this example, when you trade volatility, you will be betting on high volatility rather than the direction.
That's great. Now I know that whenever I don't have a view on the direction, I can trade volatility.
Hold on, that's not the only reason for trading options volatility. You should think of it this way: whenever you want to trade something, you need some predictability. And that's what we do while trading volatility. We try to gain predictability of volatility, so that we can select the right strategies.
How can we gain predictability of volatility?
There are certain factors that make it predictable. Let's look at them one by one. The first factor is the strong effect of variance premium. There are typically 3 types of volatility. You can learn more about each of these types by referring to the pre-reading document before this video. But for now, we'll focus on the implied and realized volatility. Generally, the implied volatility tends to be overestimated and the consequent realized volatility is lower. On the screen, you can see the implied and realized volatility. Here, the blue line is the implied volatility and the black line is the realized volatility. As you can see, most of the time implied volatility is greater than realized volatility. The difference between implied and realized volatility gives rise to a premium. This premium is also known as variance premium or volatility premium. On screen, you can see the volatility premium. You'll see that most of the time it's positive, but then there are also some instances where it's negative. Here, what's important is that there's rarely an instance where it's non-existent. In fact, even when the volatility is low, volatility premium still exists. And this is what we trade on. The second factor is volatility characteristics.
Sophie, earlier you said that we need to gain predictability of volatility. But is that something that's easy to do?
Well, it may not be easy, but it's also not impossible. There are certain characteristics, or let's say general tendencies, that we can observe and trade based on that. The first thing is volatility, in the longer term, tends to mean revert. It's basically range-bound. So a good predictor of long-term volatility is what it has been in the past. Next, volatility clusters in the shorter term. As you can see on screen, periods of high volatility are followed by high volatility, and low volatility is followed by low volatility. But these are just 2 of the characteristics. There are more characteristics of volatility. It's negatively correlated with the returns and it's positively correlated with volatility of volatility. These are some of the characteristics of volatility, and by observing these characteristics, we can gain some predictability of it. The third factor is volatility around events. This is basically another characteristic of volatility. Historically, if you see volatility, it tends to be higher prior to an event, because of all the uncertainty. Once the event has taken place, the uncertainty settles down and volatility eventually cools off. This is again something that we can trade on. To summarize, in this video, you have learnt that you can take a non-directional position and take trades based on the volatility rather than the direction. Then, you also learnt that by estimating future volatility, we can identify and trade the volatility premium. And lastly, there are certain characteristics of volatility which we can observe and take advantage of. In this course, we will create strategies around these aspects. That's all for this video.